Henderson EuroTrust seeks to produce long-term capital growth and a growing income stream for its shareholders through a portfolio of companies based in Europe. The trust is managed by Jamie Ross, who succeeded the retiring Tim Stevenson after 24 years as fund manager on the trust at the beginning of 2019. Jamie worked closely with Tim after his appointment as deputy fund manager in 2017 and then as co-fund manager in early 2018. Jamie and the team employ a rigorous bottom-up strategy to portfolio management, which involves highly detailed and comprehensive research on every company in the portfolio and on their radar. The portfolio can be broken down into 3 categories: compounders, improvers, and special situations. Compounders are at the core of the trust's approach, which are classically high-return businesses that the team believe can sustain high levels of return on capital over the long term. Improvers are businesses that don't currently generate a very high return on capital, but the team believe have a strong potential to increase their returns over time. Special situations are companies that the team find attractive for a specific feature, such as a strong dividend-paying capability and a sustainable income stream. Henderson EuroTrust, seeking growth, quality and consistency.
And Jamie Ross, welcome here in the studio. So it's been 6 months since Tim Stevenson retired. How have you found it?
It's been a good start. There's been plenty of support from Tim both before he left, and actually over the last 6 months, in between sending me photos of him on his boat, as he's accustomed to doing, lots of support. So it's a good framework we have here. It's gone well so far. Pleasingly, the performance in the last 6 months has A, been positive, but B, it's actually been driven by some of our core positions that we've had a lot of faith in for a lot of time. So far, so good.
Okay, brilliant. Well, let's begin at the beginning, if you will. How did you get into fund management?
So one of my grandfathers was in the army. My dad was in the army as well, actually. And another one of my grandfathers was a businessman. And so I don't really think I considered any other path. It was one of the two right from the start. As I went through my kind of formal education, I studied economics in the sixth form and went on to university and did the same. What I realised was that what interested me, more than anything else, was companies. It was actually trying to, I used to ask myself funny questions, walk down the street and try and understand why that shop's busier than that shop. Why is that bus empty? Why is no one queuing there? And those kind of questions, that kind of interest in companies led me to seek a job in fund management. And I joined Henderson, as it was at the time, 12 years ago, and haven't looked back.
Okay, brilliant. Well, let's start onto your investment process a little bit then. So you've got 3 buckets that you have. You've got compounders, improvers, and special situations. So do you want to take us through those 3 buckets?
Yeah, so first is a bit of background. We don't invest on a top-down view. So I don't allocate money to one of the buckets because I'm feeling like the macro conditions dictate, etc. These buckets are really a way that we can explain to people how we're invested and explain to people what type of companies we're in. So to take them in turn, the largest portion of the trust is invested in what we would call compounders. It doesn't need much explanation. These are your classic high return on capital businesses. These are good quality businesses. They have a moat, they have barriers to entry, they have pricing power. These are strong businesses that we expect will continue to be strong. And that's the crucial point. It's not sufficient for us to identify a good company. We have to identify a good company that's going to remain good or get even better. So that's the first category, compounders. Improvers, the second category you mentioned. These are really businesses that at first glance might not appear to be that strong. They might not appear to be having the same features as the compounders I was describing. And sometimes the return on capital of these businesses can be quite average. But what we've identified in those businesses is an opportunity for them to improve. So these can become good companies and these can become good businesses in the future, and with it should come an improvement in the return profile and therefore an improvement in the rating, the improvement in how people are valuing these businesses. So we spend all of our time analysing return on capital and seeing if it can improve. Can an average business become a good business? And we're willing to invest in those. So we call those very simply improvers. And then, as you mentioned, we have a third category, which is generally the smallest part of the strategy, the smallest part of the trust. And these are special opportunities or special situations. Typically with the trust, these tend to have an income bias. So we know that the shareholders, the investors, the underlying investors in the trust alongside the primary aim of capital growth that we try to deliver, the average investor also wants some income. And so our special opportunities is a way for us to gain some income exposure. And also there can be businesses that don't fit the criteria of those other two investment categories. They're not compounders, they're not improvers, but we can see a very strong reason why we think that those companies are going to improve, or why the share price is going to improve on a medium-term view. So those are the three categories.
So do you have some examples of those?
Yeah, so let me give you an example of each. I'll take them in the same order. So starting on compounders, I would highlight one of the longer-standing investments in the trust, which is Novo Nordisk. So this is a Danish pharmaceutical company. It is an exceptionally high return business, and it's exceptionally high return for a number of reasons. And all the work we've done on it over the years and over the last months has been based on why is it a high return business and can that be sustained. So why is it high return? It's high return because firstly it concentrates on one or two therapeutic areas. So this is no general pharma business that will look at all sorts of different categories of care. It really focuses on one, and that is diabetes care. So historically it's produced insulin, and more recently more novel categories such as GLP-1s, but all trying to do the same thing, help those people who have diabetes. And that is a very focused strategy. That focus leads to a very focused and concentrated cost base. And they have a team of specialists rather than a massive R&D department. So those characteristics and the fact that they produce innovative drugs with pricing power gives them a high return on capital that we believe is sustainable. So that's a classic compounder in our view. In terms of the improvers, I'll turn to let's pick a Dutch company on this occasion. I'll look at Philips. So Philips historically has been far more associated with light bulbs. That was one of the first things that they produced. They were the European leader in light bulb production. As we can all imagine, that may have been a good business back in the day, may have been a good business at some point. It's certainly not a good business today. So that category became quite commoditized. So what do? They changed. They moved slightly more towards consumer electronics. So they started producing CD players, TVs, mini disc players, those kind of things. And again, as with their former category, light bulbs, they became quite commoditized. And the business now is shifting far more towards health care equipment. And that's an area that we think they have pricing power. It's an area we think they have a decent chance to improve their return on invested capital and to experience some good growth. So that is a business that the return profile should improve. And then we're not talking about over the next month, we're not talking about the next 6 months, we're talking about the next 5 years, or even longer. So that is a classic example of an improver within the fund. And then special opportunities, I could pick many different businesses here. And bear in mind, this is always the smallest part of the trust, always the smallest part of the strategy. But the business I'll pick, let's go to Germany, and let's go to what is a fairly controversial company at the moment that's attracting some attention and some media, which is Bayer. So Bayer, at first glance, is a large conglomerate structure business that is quite hard to analyse. It has many different areas that it's exposed to, be that animal health, a business that actually they're looking to remove themselves from, or crop science, one of the core businesses they operate in, or pharma. It's quite a complex business. For many reasons over the last year and a half, 2 years, it's significantly derated. And by that, I mean the valuation has lost a lot of ground. So this used to be a mid-teens PE business, to put some rough numbers around it. It's now a mid-single digit PE business. So it has become a lot less attractive to shareholders. Why is that the case? They did a large deal, Monsanto. People didn't like that deal. That deal brought them exposure to a product called glyphosate, which we won't spend too long on this, but essentially it's come under a lot of pressure through litigation in the US. And those two key issues have resulted in this huge fall in the share price. That kind of pricked up our interest. That made us interested in that business. And we think that the market is being far too fearful about this business and is looking at the litigation in the US and pricing in more than the worst possible situation we can imagine in terms of how much they'll eventually have to pay out. So we think there's a very good special opportunity there. It's not a great business, and it's not a business that we see as capable of improving dramatically, but we think it's substantially undervalued, and the catalyst is all about this ongoing process of litigation in the US, where we believe that the eventual amount they'll have to pay out will be far less than what people are pricing today.
Brilliant. Great, Jamie. Okay, well, we've got a question from the audience here. Why Europe over alternatives or emerging markets?
Good question. Look, I mean, there's many different ways to approach this. I'm certainly no specialist on most of the other asset classes, but there's a couple of things I'd say. Firstly, for quite a lot of, in my opinion, short-term and transient reasons, Europe actually looks relatively good value. And we've seen big outflows from Europe. It's very out of favour. It's very contrarian. So what are those short-term reasons I don't believe are that important? Well, politics for one. Let's not even get started on Brexit or even the Italian political situation. There's many reasons to not like Europe, and that is being reflected in the valuation of European shares. So that's one of the reasons. The other reason is that Europe is perceived as being a cyclical market, and people are worried we're towards the end of this cycle and the economic conditions are starting to weaken globally, and so people shoot first and ask questions later, and that region that they shoot is Europe. So Europe gets sold off in those times of cyclical concern. So that is one reason why Europe actually to us looks reasonable value. Another thing I'd add is on the same valuation side of things, let's not look at things over 1 year, let's not look at things over 5, let's look over 30 years. And actually if you look at a number of different asset classes over a 30-year period, so a very long period, fixed income across the board looks exceptionally expensive versus history. I don't think that's a particularly controversial statement. And that is both on the government bond side and on the corporate side as well. When you look at equity markets, in general, they actually don't look that expensive versus their 30-year history. And the metric I'm using is dividend yield, actually, to make them as comparable as possible with fixed income. And within equity markets, Europe actually stands out as one of the only regions globally that's actually slightly cheaper than its 30-year average valuation on a dividend yield basis. So the short-term fears, there's valuation in that market. And at the end of the day, valuation is one of the key things that matters for long-term performance, as we all know. And what's more, there are good companies in Europe. I get frustrated telling people this. There are really good companies, whether this is a Swedish lock manufacturer, Assa Abloy, or a Dutch semiconductor equipment company, ASML, or Swiss Pharma. I mean, the list goes on. There are significantly underappreciated companies in Europe, and that is why I think Europe is a good place to be relative to other asset classes and other regions at the moment and more in generally.
Let's look to your portfolio. It's quite concentrated. You've got 41 stocks, and the top 10 are 40% of it. So this is quite high conviction. What's the maximum you're willing to go to? What's the minimum? How's the portfolio going to shape?
So historically, EuroTrust has operated anywhere between 40 at the low end of position count and 60 at the upper end. My view throughout the time I've managed money, both on this product and on previous fund I was involved in, has been that a relatively concentrated portfolio is the right way to go. There are several reasons for this. One, I spend all my time researching companies. I spend all my time analysing companies. And if I'm then going to spend all this time analysing a business and then take a tiny position, I don't see that as the right way to go. So I like to have fairly decent position sizing, and for that reason, a more concentrated list appears the right way to go. Also, just being commercially aware, we live in a world increasingly where, quite rightly, investors are looking to alternatives. Investors are looking to passive as a means of getting exposure to equity markets. I believe firmly that passive strategies are an attractive thing for a lot of people in a lot of circumstances. I also firmly believe, otherwise I wouldn't be doing what I do, that active equity also has a lot of value to be added. But I don't believe that there's an attractive middle ground. So actually I think you're either active and you are running relatively concentrated portfolios, or you go passive. And what I don't want to be is somewhere stuck in the middle. So looking towards the future, I think you can certainly expect the number of holdings in the trust to remain at the very low end of that historic exposure, the 40 to 60 that I mentioned. But it won't go below that. 40 is actually the mandated amount. That is the level that the board has deemed appropriate. And so for the moment, 40, 41, 42 holdings, that feels about right to me.
How much would you consider Europe's political landscape a risk factor to the region's equity markets?
Short term or long term? Short term, of course. People get concerned about Europe and concerned about the Italian political situation, and they sell Unicredit. People get concerned about Brexit, and all the UK domestic cyclicals will sell off. Does that make any sense in the short term? Possibly. I mean, political events have an impact on the economics of a region in the short term. Does it make sense long term? I don't think it does. Good companies will continue to be good companies. I mentioned briefly Assa Abloy earlier on. They sell locks. Increasingly, they sell quite sophisticated smart locks. Are you going to decide not to replace your door and replace the lock that comes with it because we have a hard exit or a soft exit, or because X government is in power in Italy rather than Y? I don't think you are. So long term, I do not place a lot of value and a lot of ability of political environment to impact on equity valuations. And so when I do my analysis on companies, which incidentally is always based around a 2-year, 3-year, 4-year plus view, am I thinking much about the political situation? I'm not really at all. So do I have an interest? Of course I do. I think it's very hard to not be interested in the political environment. But does it impact the investment process and the philosophy of the trust? Absolutely not.
Okay, well, this is a good question to follow on with that. How much is Europe affected by the US-China trade war?
Yeah, it certainly is. And again, I would answer that in a similar way. In the short term, it certainly is impacted, and we can see this. So when I talk about is a good business going to remain a good business even if there's trade concerns or there's political concerns? Of course it will. But in the short term, it can be impacted. And if we look at certain regions within Europe, certainly those that are very export heavy, the obvious one is Germany. Can we see companies being impacted? Yeah, of course we can. If we look at the semiconductor space, historically a very cyclical area of the market, that's been really beaten up. And it's been really beaten up partly because of ongoing political rhetoric between those two regions you mentioned. That's been one of the key concerns. The auto sector is another obvious thing to point to. So yes, it's having an impact short term, long term, questionable impact. But again, one of the things I would emphasize is firstly, it's not in our process to try and analyze those kind of things. But secondly, our process is biased towards that first category of investment that you and I talked about a few minutes ago, those compounders. Those compounders, those good businesses are on average going to be less impacted by those cyclical or macro or political concerns that some of the more cyclical businesses might be impacted by. So do we have a trust that's ram full of semiconductor companies and autos companies? No, we don't. Could that be the correct investment strategy? I mean, who knows? But it's not something we're particularly exposed to. So we tend to have a quality bias.
Okay, Jamie, we've got to get the crystal ball out again. So 12 to 18 months, where do you see markets?
Absolutely no idea. Let me give you a more thoughtful answer to that. We talked about valuation levels. I think that's important. So if I go back to the start of 2018, just to rewind a little bit, European equity markets were actually trading on a forward price to earnings multiple of kind of 16, 17 times. And at the time, everyone was very confident about the world. Everyone thought that the economic environment was very buoyant and that we're away to the races and that there was no trouble on the horizon. Turned out not to be the case. Equity markets weakened, equity markets sold off as the year went on and as the economic situation worsened. At the start of 19, and we're only a few months away from that now clearly, but at the start of 19, firstly, valuation started a lot cheaper. So European equity markets are now trading on 13, 14 times earnings. I've already explained my argument on long-term, dividend yield analysis on a 30-year basis. So there's value for a start. The second thing is that you won't talk to any investors. You won't sit on this table and talk to other fund managers who say that the world economy is fine, there's no issues. Everyone knows that there's economic weakness. So that is in the price. If everyone knows it, it's in the price. And the third thing I'd add is that we have exceptionally accommodative monetary policy. Now, we could have a significant discussion about whether that is a good or a bad thing, and I think we probably both know the short answer to that in the long term. But that significant monetary accommodation is a real boost to equity markets, both in the short term and in the medium term. So we have a market that is, in my view, not that expensive. We have a European equity market that actually looks downright cheap compared to other asset classes and compared to history itself as well. And we have that accommodative monetary policy. So actually, all those things together make me feel, I'd say, to use a horribly overused expression, cautiously optimistic about equities from here.
Okay, I've got one more question for you, Jamie, from the audience. Is the fund currently fully invested, or are you holding cash, basically?
It's actually a very, very important question, and I'll spend a little bit of time on this. So if we go back to midway through last year, we actually had a net cash position, which is quite a rare position for an investment trust that obviously can utilise leverage. We had a net cash position of about 3%. As we went through the second half of the year, we invested cash into the market, and today we stand with a position of about 3% leverage. So we are utilising more than the cash we've got. We are borrowing and investing that cash as well. And that is a fairly big difference from 12 months ago. Why has that happened? Firstly, it hasn't happened because I got my crystal ball out and said, oh, I feel positive about the world, let's buy some equities. I never make decisions on that basis. So it has happened because we've looked at the individual businesses that we own, and we found more reason to buy and to add to positions than we have found reason to sell or trim positions. And also when I think about my watch list, we've always got a watch list of 10 to 15 names. We're finding that watch list growing. So we found an opportunity to invest more capital as the year went on in 2018. So we are more than fully utilised, which does not reflect a top-down decision from me, but if you look at that leverage position on the trust, that must reflect this cautiously optimistic outlook that I voiced earlier.
Jamie Ross, thank you very much for joining us in the studio today. It's been really great to have you.
Thanks, Mark.
And I'd like to thank the audience as well for all of your great questions. We hope you found some useful insight in today's discussion. Apologies if we didn't get round to your question, but if you would like them answered, then please email investment.trusts@janicehenderson.com and the managers will respond as soon as they are available to do so. A recording of this episode will be available shortly at janicehenderson.com/trusttv. For more information about Henderson European Focus Trust or Henderson EuroTrust, you can visit their websites at the addresses below. Until next time, goodbye.